Thanks so much for joining us this afternoon. We are here to talk a little bit about how we are going to approach the home buying process in 2021. I'm sorry, in 2020. I'm already ready for 2021, apparently. It has been a little bit of a crazy year, and that might mean you have some questions about what is going to be different if you're trying to buy a home right now. We're going to cover all of the basics, but then we'll also speak to some of the circumstances that may be just a little bit different than if you've experienced this before. We got a great question already in the chat in terms of whether or not we're going to be recording the webinar. We are recording today. I will send this out to everyone who has registered in just a couple of days after we finish up. In terms of questions, if you have any questions, please feel free to go ahead and put those in the chat. We will do our best to answer them as we go along. If we are unable, due to time's sake, to get to all of the questions while we're doing the presentation, then we'll have some time at the end to handle that as well. With that, let me go ahead and introduce who we've got on our webinar today. My name is Eva Bloom. I am the education specialist here at the credit union. That means I get to talk to people about all different types of financial questions and issues and goals. And home buying is certainly a big one. So I am really, really glad that you all have joined us today. We also have Kristen Riley, who is one of our mortgage originators. Our mortgage originators office is actually now at the Schaefer Street branch. For those of you who have been with the credit union for some time, you may remember that we used to have folks at the East State Street branch as well. So we've done a little renovating, and now we're going to be all over at the Schaefer Street branch. That is where Kristen is. And then we also have Shelby Pfizer, who is another one of our awesome mortgage originators on the call today. Also located at the Schaefer Street office when she's in the office, but as a lot of folks may be experiencing with everything going on with the current health situation, Shelby is also doing some work from home. We do have our mortgage manager, Laura Humphreys, who's making sure we're all doing our jobs and keeping us in line here today. So we have lots of great knowledge available to help answer your questions. Please feel free to go ahead and chat those in as they come up, and we will get to them just as quickly as we can as we work through today's presentation. Great, let's get started. We are going to talk about buying a home. We're going to cover a number of different things so that you have a full understanding of what this process might be like. We're going to start by talking about the mortgage process, how you can confidently navigate it, how things may have changed in 2020. We're also going to talk about how you qualify for a mortgage loan, what you need in order to get that loan, and that it might not be quite as tough as you think. We are going to cover private mortgage insurance, also known as PMI, and that can help you buy with less than 20% down. We're also going to talk about closing costs, what they are, why they're so important to your mortgage process, and finally, we'll talk about loan types, what options are available here at the credit union, and what may be best for you and your situation. Let's get started. First, to get into the mortgage process, let's take kind of a bird's eye view. You'll probably be familiar with the idea that your mortgage process is going to have a number of different steps. Let's take a quick overview, and then we'll break each one of these down one by one. Your mortgage process is going to start with an application. Then you're going to move into a contract, which is when you've found a house that you want to purchase and negotiated a price. After you're in contract, you'll do an appraisal of the property to determine the value. That will then lead into a title search, which will help determine the seller's legal right to sell you that property. You may or may not have some inspections. You'll want to start investigating homeowners insurance to protect your new investment. And finally, you will make it to the closing stage when you get to sign all of your paperwork and most of the time take possession of your new home. Great. I hope that gives you a little bit of an idea of where we're going as we dig into each one of these steps. Let's start with the application process. I am actually going to break that down into 3 different steps because it's a very important part of the process. And we want you to be informed and understand how it's best for you to enter into this application process. Most folks will start with a pre-qualification. That is really like your first steps, and that's going to determine the path that's going to take you to getting your mortgage or getting your new home. During the pre-qualification, you're going to review your needs with your mortgage originator. You can discuss what monthly payment you might be looking at, and that can help you and your mortgage originator determine your loan amount. At this stage, when you're reviewing your needs, your mortgage originator may also talk to you about different types of loans that you may want to consider so that you're sure you're getting the one that's best for you and your situation. Once you have a pretty good idea of what that mortgage might look like in terms of type and payment amount and loan amount, you can progress to your actual or formal application. During this process, we're going to collect your personal information, date of birth, name, social security number, all of the things you would expect to include when applying for a loan. We're also going to collect some details on your employment, your income, and pull a credit report. When we collect all that information, we need to also provide supporting documentations to verify that all that information is correct. We have a number of different ways to do this right now that can make it really easy for you. Many folks, especially in 2020, are doing their applications online. So we have a service called Mortgage Click that will allow you to provide that information that's needed for the application, and then also to go ahead and upload to your online application things like your pay stubs, maybe bank statements, W-2s, tax returns if that's required. If you aren't as keen on that online upload, we do have a secure email system so that you can scan items and send them to us, or actually to your mortgage originator. Or of course, there's always the ability to drop off copies of those documents in person at any of our branches, and we can ensure that they land in the hands of your mortgage originator. This supporting documentation is really important for your process. And having all of the supporting documents in order when you go to submit your application can make it so much easier for you and your mortgage originator. So we do recommend, and when you start to apply with us, we're happy to provide you a full list of everything that you might need. We do recommend you having those compiled, maybe start a little folder for yourself as you get ready to do that application. We do have a question coming in the chat. What should you do if your spouse is employed by yourself or you're self-employed? If you are self-employed, and my mortgage originators or Laura can come in here and correct me if I'm wrong or if they want to take this. So self-employed, yes, thank you. So if you're self-employed, generally what we'll do is collect 2 years worth of tax returns so that we can determine what that type of income looks like as it changes from year to year. So income variations are something that's a little bit more common to a self-employed borrower, and that's why we rely on the tax returns to verify that income. And that's something, if you want to discuss a little bit further, our mortgage originators would be available for a consultation to really understand your situation and the best way to get the documentation that we need for your application. Okay, now once we've got that application in, we've got the supporting documents that we need. Those are going to be submitted to our underwriter so that we can take a look at whether or not we're able to offer a loan on your application. While we're doing that, you're also going to have the opportunity to review and sign your disclosures. This goes over everything that you and your mortgage originator have talked about, and also gives you some details about how to be prepared for the rest of your process. it can be really important to look at those carefully and to sign them and get them back in a timely manner to your mortgage originator. To make it even easier for you, electronic signing is available for those documents. You don't even have to get out your pen and paper. As you move through the application process, the end stage is going to be your pre-approval. Once we've reviewed all of that documentation, we'll determine whether or not we're able to offer a loan for a specific amount. And that's going to be based on income, credit, and the amount of your down payment. That offer is good for 90 days, but that is depending on or requiring no change to the application information. So if something major changes on that application, then we may have to go back and look at that pre-approval again. So generally though, good for 90 days, pending no major change to that personal or application information. Now, one of the things that is a little different in 2020, it has been moving in this direction over the years, but I'm told that it's getting a little firmer right now, is that most realtors are requiring some pre-approval, definitely at least a pre-qualification before they're going to make an appointment to show you a property. So there are a lot of different health considerations that we need to take into account when we're doing face-to-face, more contact between individuals. So what many realtors are looking for is a little bit of assurance that you've done the legwork that you need to do to be in the right place to buy before they're able to show those properties. Now, as we've talked about the application process, you might be thinking about, how am I going to do all of this in today's environment? I mentioned a couple of times that we have some really great online options, and that is what a lot of people are doing right now. First of all, it's super convenient. It allows you to get online and fill that information out whenever you have the time, but it also keeps both parties safe in their own spaces and limits some of that contact. If you want someone to help you through the application a little bit more, we can certainly do appointments. So a lot of our appointments right now are taking place on the phone, again, to limit that contact. And we do encourage a phone appointment when possible. If you really would like to come in and sit down with someone at the branch, we have some availability for that as well. So we're willing to try and work with you any way we can, but certainly a lot of folks have been enjoying the ability to do this online or by phone. Once we've gotten our pre-approval, you are ready to really start shopping in earnest. There actually was a study that's done, and they determined what is some of the difficulties that buyers face when they're buying a home. So this is something that came out from Forbes. And actually, one of the things that buyers faced as a hurdle was actually finding that property before they get pre-approved. So that is why the application process comes before this contract process and is so important. By the time you get into your contract, you really want to know what the details are. That contract includes a finalized price. It includes all of the details about your transactions, including what types of inspections you may or may not have. And in terms of what inspections you might need for the property, it's often a good idea to talk to your real estate agent and take advantage of some of their expertise in determining what inspections you may elect for your purchase contract. When you sign that contract and you have your price set, the timeline starts in earnest, because most contracts will have a deadline by which you need to get all of these details finalized. As soon as you are in contract, you have those signatures, you want to get that directly to your mortgage originator so they can start working on the rest of that process for you and make sure that you're going to hit your deadlines. If you are getting we got another question here. If I am getting pre-approved for a mortgage, does it hurt my credit score? There can be an impact to your credit score anytime your credit report is requested by a lender. So that may be what we're talking about here. However, the credit score really has a number of different factors, and it's very difficult to say without taking a look at all of those factors exactly what the impact of that credit report being pulled will have. In general, FICO lets us know that about 2 of these, what are called hard inquiries, which is when you have your credit report pulled, generally we're allowed about 2 of these every 12 months before we see any real indication that it's going to start negatively impacting our score. However, credit reports are very individual and very specific to what's on that report. There are a lot of different factors. So I happen to be kind of a credit score, credit report nerd. If this is something that you want to discuss with me a little bit more after this presentation, I would be more than happy to talk about some of the factors that may influence an individual score when it comes to having that credit report pulled. So very good question. Great. We are going to move on from our contract to the next step in our mortgage process, which is the appraisal. You don't want to buy a property that you're overpaying for, right? This is a really big investment, and that's why an appraisal is such an important step, because it determines the market value of the home. The appraisal is going to be based on a review of the inside and the outside condition of the home. The loan amount, as we've talked about when you go through that pre-qualification and pre-approval, is going to be based on the value of the home. So you need your appraisal value to be in line with what we've discussed in terms of lending on that property. The way appraisals work is that the credit union will request an appraisal through one of our third-party vendors. Neither the borrower nor the lender gets to choose who does the appraisal, simply because it needs to be based on an unbiased assessment of the property. So if the borrower or the lender are picking somebody that they think might give them the number that they need, that may not be an unbiased way to get that value. The appraisal is based on current market conditions. It considers the sale of similar properties in the area, and those are called comparables. Once your appraisal has been generated by the person who's going out to see the property, it comes back to the credit union, to our underwriting staff. They are going to take a look to make sure it contains all the information we need and that it's complete before it is released to you, the borrower. So your mortgage originator and you will not see the appraisal until it's been through that kind of quality control check, so that we know it has what you need and you can use it to move forward. The appraisal is not provided to your seller. Right now, the timeline for an appraisal in Athens County is about 2 to 3 weeks. It could be a little bit longer in larger cities or more outlying counties. The reason for this is, as we've kind of all experienced, things can be a little bit harder to do in our current climate. There are a lot of health precautions that we need to take into consideration. Not only are things a little bit more complicated when it comes to logistics, there's also an incredibly high demand in the market for these appraisals, for people purchasing homes and also refinancing, because our mortgage rates are really at a record low right now. Just something to be aware of, that this process is taking about 2 to 3 weeks when we get that appraisal ordered. The next step is going to be a title search. This title search protects you and it protects the credit union, because it determines whether or not the seller has a legal right to actually sell you that property. It also determines whether there are other claims against the property or claims against you as the borrower. What are they looking for when they do a title search? So first, they want to look to see if there's other mortgages on the property that haven't been properly released. The last thing you want to do is purchase a home and find out that somebody already has a mortgage on it that you are not responsible for, but it is still against the property that you own. It also looks for mechanic liens. This is generally if there's been improvements to the property that haven't been paid for, outstanding property taxes, or unpaid debt on the borrower's side. So this could be like a civil judgment where a borrower has been ordered to pay a debt by a court, but it hasn't been repaid. And that can influence the ability for the lender to secure their collateral, which is going to be the home that you purchase. The next step in our process is inspections. Again, the type of inspections are going to be specified in your contract. Sometimes they include things like termites, a gas line, or a septic. These are not the same as the whole home inspection, which really looks at the stability of the home in general. So you may decide to have individual inspections and also a home inspection. Again, your realtor is a really good resource to determine what you need for the specific property that you are looking at. We're getting really close, folks. Once we've got the appraisal, the title search, the inspections, you're just a couple steps away from owning that new home. As you work through this process, one thing you're going to be keeping your eye on is getting your home insurance in place. The credit union requires you to have a policy that covers at least your loan amount. However, your homeowner's insurance agent is going to be able to work with you to determine what you really need to protect that property. This policy must be in place on the day that you sign that paperwork, effective on the day of closing. And the first year needs to be paid for either previous before you get to closing, or it can be included in your closing costs. After you have that contract signed, you can begin shopping for your homeowner's insurance. But you need to have your agent chosen and get your final details in place at least 1 week before you close, so that you can make sure this item isn't going to be holding up your final closing and getting your possession of that property. Now, many companies are offering online or by phone consultations and electronic signatures to meet the needs of our current environment. So if that is something that is important to you, then there's lots of different ways that you can work with agents to do all of this by phone or electronically. Okay, guys, we have made it to closing. This is the mortgage originators and the home buyers' favorite day, because all of the hard work is done. Now we just have to go to the title agent's office and sign that paperwork so that we legally take possession of the property. Closing, as I mentioned, is at the title agent's office, and this is in person. So you will meet with the closing agent, the title agent, on the final step to go over all of that paperwork. And if you've heard anything about mortgages, you know that there's probably a fair bit of signing that you'll have to do on this day. But that in-person visit can really make sure that you understand what's included in those documents, the very important contract that you're going to sign, and you want to make sure you know what's going into that. I hope that going through that process can help you understand a little bit more about how you might navigate it from where you are today, maybe thinking about I want to buy a home, to actually getting to the point where you're holding the keys to your new home. Now, we have to get qualified to purchase this loan, right? So let's take a look at that. We did talk a little bit already about our FICO score or our credit score, and we're going to dig into this a little bit longer. So I did get a question here about private mortgage insurance, and that is something we're going to cover in detail. So I'm going to have you hang on just one moment for me, and we will go over that in that section in just a second. So we're going to go back to our credit score real quick. And we are going to first know that when you're getting qualified for a loan, we know at the credit union that each borrower is different. One of the benefits of using the credit union for your mortgage loan is that we have local lending decisions. The people who are going to take a look at your application are real life people. They are not a computer program. We are going to look at your situation. We are going to look at our guidelines, and we are going to try and find the best way to make your goals happen. And that is a major benefit when you get a real human to human connection looking at this very important purchase that you're making. We do have some qualifications just to give you some guidelines of what we're looking for, so we'll go over those right now. Of course, the credit score is one of those. You probably all expected that your credit score would be used as part of your loan qualification process. We do use the FICO scoring model. It is the most commonly used model in the US. It's a 3-digit number, basically, that determines whether or not you're going to pay back a loan based on a number of different categories. It is used by about 90% of US lenders, and it ranges from 300 on the lower end to 850 on the higher end. Now, your credit score is important as part of your mortgage process, but it is also important to have enough credit for us to be able to determine your liability or how likely you are to pay back your loan. For that reason, most borrowers are going to need a minimum of 3 credit references, and they're going to need those for 2 years. So let's break that down. It does get a little jargony. So 3 credit references, that's 3 different types of loans or credit cards. So I've got an example here with icons on the screen. I've got 2 credit cards and an auto loan. That gives me my 3 references or my 3 accounts. And then I want to have had a history with those 3 loans or credit cards for a minimum of 2 years. So we're looking at that as a minimum in order to judge the ability to have that enough credit history to make a decision on the loan. Credit is very important, not only about whether or not we're going to be able to offer a loan for an individual borrower, but also because it affects how much you have to put down, whether or not you're able to get private mortgage insurance, which we're going to talk more about in just a second. Your credit score is very important to whether or not you're able to have that based on the private mortgage insurance guidelines. Let's take a look at some numbers here. Let's just use some easy math and say that I want to buy a home of $100,000. If I have a credit score of 660 or above, then I'm likely to be able to get that private mortgage insurance, which means I may only have to put down 5%, which on this dollar amount for my loan is $5,000. Now, let's say I have a slightly lower score at 659. In that case, I may not be able to get private mortgage insurance. I may be required to put the full 20% down, and then my down payment jumps up from $5,000 to $20,000. So we can see here how important that credit score is to when you can purchase a home and how much you need to put down. We do have a lot of information available about credit scores for folks who are interested on our financial education resources online, which you can find on our website. We talked about credit and the importance in the loan qualifications, but we also want to make sure that the borrower has the ability to repay the amount that we're lending. It's not good for the borrower, and it's not good for us as the lender if those payments are going to be unaffordable. For that, we use something called the debt-to-income ratio. So what is this debt-to-income ratio? Essentially, it is all of your payments or obligations compared with your income. And we get a percentage that can give us an indication about whether or not you have the ability to repay on this loan. So we're going to use this as the ability to manage payments, repay your debt. And let's take a look at an example. Let's say I have a $1,500 total debt payments a month. So maybe I've got my current rent, I've got an auto loan, I've got those credit cards that I mentioned. If I add that all up right now, it comes to $1,500. Let's say that my gross income is $4,000. So to get my debt to income ratio, I'm going to take 1,500 divided by 4,000, and that's going to come up with a debt to income ratio of 37.5. This is the number on our slide here because this is kind of the sweet spot where we like folks to stay. We think it's a pretty affordable debt, pretty good indication that that payment is affordable. If your debt to income ratio is at 37.5%, of course, we look at every individual loan and take a look at that borrower's situation. We do have a guideline in terms of the maximum amount that we can go for our credit to debt ratio, and that's 43%. You may be interested in calculating your own debt to income ratio, and we have provided the ability for you to do that with a home loan payment tool. You may have noticed when you logged in today or when you log off, there are some supplemental resources that you're able to download. I will include those with the email of this recording so that you can take a look at that and you can do some of these calculations on your own if you're interested. And of course, we are always happy to sit down and work this with you or do this by phone to work through this with you so that you understand. Now we're going to pause just 1 second. I did have a couple questions come through. Let me take a look at those. Okay, if you are above the 650 credit score and only able to put 5% down, how does the amount of private mortgage insurance based on if you choose a higher or lower down payment? So in general, the more you put down, that can decrease your private mortgage insurance. I am going to ask one of the mortgage originators here if they can maybe just jump on to the chat and maybe include a little information to everybody about exactly how that relationship works, because I know it's a little bit more complicated than if I put down 10%, it's this amount of my total loan. So it does change a little bit based on how much you have down, but the details of that, I'm going to ask one of our mortgage originators to chime in and give us a little bit more information. So thank you so much for that question. Then the next question we have is, do student loans factor into the debt to income ratio? Yes, they do. So that is something we'll be taking a look at as part of that total debt. If student loans are currently in forbearance, unfortunately, we do still need to include some amount of that future payment into that debt to income ratio. And again, that is going to be a good option for you to discuss with your mortgage originator for your specific situation so that you know what you're looking at. We've also got another question coming in here. How would you calculate your debt for credit cards? Minimum amount they need to pay, so your minimum due, or how much you pay per month. In general, we are using the information that comes in from a credit report, and they list the minimum payment. So if you are calculating, you can calculate on that minimum payment that's due on that credit card as part of your total debt. Another really good question. Thanks so much for these questions, guys. I think it really helps us all understand what we're talking about. Okay, no more questions right now, so we'll keep on moving. We talked about the credit to debt ratio, and we talked about needing to include all of our debt payments in that number. When we're talking about a housing payment, that can include a couple different parts. So it includes, of course, your principal and interest, what you're paying on the amount you borrow and the interest on that. If you have private mortgage insurance, that's also going to be part of your total housing payment and needs to go into that debt to income ratio. Homeowners insurance and your real estate taxes also need to be a part of that total payment. So when we're talking about the housing payment that we're going to include in our credit to debt ratio, all four of these factors, if they apply, of course, if you don't have private mortgage insurance, you don't have to do that one, will be a part of that total calculation. And we will do your final debt to income ratio based on that projected payment with all four of these factors included. I did have another question. Let's take a look here. So if we are a co-signer on a loan that someone is not paying, does that affect the individual's profile? Unfortunately, it does. As a co-signer, that also impacts your credit score. So when that payment is not being made by the primary borrower on that loan, unfortunately, it's going to show up as a late payment on that individual's credit report and will start to affect that credit score as well. I hope that that answers the question, and the next step might be to work with that individual, that primary borrower, to see if they can find some way to work that out to bring those payments current so that it no longer affects the cosigner's score and report. Great. We're going to move on down to down payment. So we've talked about some really important factors when it comes into our loan qualifications. We talked about credit. We've talked about the ability to repay with that debt to income ratio. Your down payment is also part of the way that you'll qualify for your mortgage. Your down payment is going to be your personal investment, so your stake in the property. If a lender is getting ready to lend a large amount of money, they want to know that the borrower has some, I guess you could say, skin in the game too, that they're invested in this property and they're going to do what they have to do to get this loan paid off. And that can be represented by the amount that they're willing or able to put down on the property. When we make a higher down payment, it lowers our monthly mortgage payment because it lowers the amount that we need to borrow to buy that property. The down payment is going to be due at closing. However, it is verified at time of application. So we talked a little bit about maybe having to supply bank statements as part of those supporting documentation. So that's what we're looking for in part when we look at those bank statements or other financial statements, is where are the funds for this down payment going to come from? The last thing we want to do is get all the way to closing and realize we didn't have enough money to make that full down payment. So that's something that we talk about right up front to make sure that we're not going to have any issues as we get further down the road, or to eliminate as many of those issues as we can. At the credit union, our down payment requirements break out this way. So first of all, it's important to say that we don't have any zero down payment options. Most buyers are going to be required to put at least 5% down, and that would require them to have private mortgage insurance as well. For our first-time home buyers, we do have an option of 3% down, and we can consider gifted funds in some cases. So if you know that you have a really awesome parent or relative who wants to help you buy a home, that's something you want to discuss with your mortgage originator upfront, that those funds are going to be gifted, to see how that affects your total situation. Now, we talked a little bit about these bank statements, or how we verify this down payment. So the ownership of the funds is really important when we talk about our down payment. It must come from funds that the borrower owns. And how do we prove that ownership? Unfortunately, for our regulators, possession is not enough to prove that those funds belong to you. We need to verify the source. And we do that by making sure that those funds have been in the borrower's account under their name for at least 2 statement cycles. If someone is doing their saving for their down payment in cash, this can delay their ability to buy that home, because that cash needs to be in their account for a minimum of 2 cycles before it's able to be used for this purchase. Another reason that we discuss that down payment right up front when we're getting qualified for our loan. Great, now we are ready to talk about private mortgage insurance a little bit more. Thanks so much for your patience on that question. We're going to go over the basics. Private mortgage insurance is going to be required on loans with less than 20% down, and it allows for a smaller down payment, which, as we saw when we talked about the difference between a 5% $5,000 down payment and a 20% $20,000 payment, helps a lot of individuals buy a home and make that investment in their future much sooner. It allows us also to say yes to more loans, and we love to see people buying their own home and making those dreams come true. So we are big fans of private mortgage insurance where it's applicable. So your private mortgage insurance is going to be paid with your monthly mortgage payment. That makes it very easy for you. All you have to do is make that one payment. We take care of satisfying the payment to the private mortgage insurance. Now, the question that we got earlier is, how long do I have to have private mortgage insurance? Your private mortgage insurance must remain on the loan for at least 2 years and until your loan to value is 78% or below. Depending on your initial down payment and the value of your home, that can take more than 2 years. And I will see if maybe one of our mortgage originators can chime in on how long folks generally have their private mortgage insurance, pending that each person's situation will be different. So, and then we have regarding gifted funds, how long is a cycle? So if we're talking about a statement cycle, as I mentioned previously, those are generally 30 days. So it's generally about a month. Every institution has the ability to do their statement ending and starting cycles on a different time period. But if you look at your last bank or account statement, it should tell you when it started and when it ended. So I think I got that answer to that question. Thank you for asking that. So how do we work with down payment assistance grant programs? I'm going to ask one of our mortgage originators to weigh in on that if they can. We'll give you just a second to chime in here. Okay, we might be having some technical difficulties getting our answers from our originators. So I'm going to ask you to hold on to that one for just 1 second, and we will get to that answer to that question as soon as we possibly can. And if we are changing, so when we talk about loan qualifications, if we're starting a new position and the increase in pay, yes, it's always a good idea to include that offer letter with your loan application and something to discuss with your mortgage originator. And they can go over the details about what we can verify and count for that income for each individual situation. But if you have that offer letter from the company, that's definitely a good part of that supporting documentation that you'll want to include. Great question. Great, guys. We are down to our closing costs. So we talked about a number of different steps in that loan process or mortgage process first section. Now we're going to dig into some of those closing costs that make that process possible. Great. If you think about what you're doing when you're purchasing a home, you are making one of the most important transactions of your financial life. You are going to legally transfer a large asset from the seller's name to the buyer's name, and you're going to secure often a significant amount of money to do that. So it's no wonder that there are a number of services that are needed to make sure that that all goes smoothly. And that is essentially what we're talking about when we're talking about closing costs. We're going to talk about basically 3 types of closing costs. And hopefully this will demystify some of those numbers that go into that disclosure or that total amount that you see, how much I need to pay to get this home loan. There are 3 different parts. We're going to talk about loan, we're going to talk about legal, and we're going to talk about title search. For our loan closing costs, these are the services that are needed to get you the money so that you can make the purchase. This could include an origination fee and also that appraisal we talked about. Next, we need to make sure that this sale can legally happen. So we are going to talk about publishing the legal transfer of ownership of a property into the official record, which is called the recording. Then we also need to have the preparation of the deed, and that's going to be the legal document that's signed to transfer the property from the sellers to the buyers. The last part of our closing costs is going to be the title search. And this makes sure that the sellers can legally sell that property to you, that they are the current legal owners, and they also facilitate the settlement of this transaction in the title portion of your closing costs. And that's where your title agent is going to sit down with you and go through all of the papers that they've prepared to make sure that all the I's are dotted, all the T's are crossed. They will also handle the distribution and transfer of funds from one entity to the next. So down payment funds, loan funds, all making sure that those folks get the money that they need and that it gets there in a timely manner. When it comes to closing costs, they're going to be affected by your loan type, your credit score, and those are paid at closing from verified funds. They cannot be included in your loan fund. So we talked about what we need to do to verify funds. So in addition to verifying funds for down payment, we're also going to take a look at those funds for closing as well. Now, I have a couple of questions coming through the chat. I'm getting a little close to one, so I'm going to go ahead and get through the loan types, which is the last thing we want to talk about here. And then we're going to circle back to those questions. So I appreciate your patience, but I know that we are kind of doing this over the lunch hour too. So if there are folks that need to jump off the call right at 1, I want them to have the ability to get as much information out of the presentation as they can. If we're unable to get to you before you have to jump off, we do have email addresses and your questions, and we will be happy to follow up with you to make sure that you get what you need. Great. So hang on with me for just one more second as we talk about loan types. This is something that you're really going to want to take advantage of the expertise that your mortgage originator has, because they're familiar with the ins and outs of all of these loan types and are going to help you get the one that's best for you. However, it's very important that you as the buyer understand some basics here so that you can kind of know what might be the best fit and understand why one type is chosen over another. So let's take a look at probably the most common type of loan, which is your conventional mortgage. And this is what most people think about when they think about a mortgage. It's a fixed rate, it's a fixed payment, and it's best suited for someone who's going to own the property for a really long time. There are various terms, although probably one of the more popular ones is that 30-year fixed, which gives the buyer a longer time to pay back that loan and can help make that payment more affordable. The conventional mortgage is a favorite because it offers that payment certainty. Because your rate is fixed, you'll know that every month you're going to make a certain payment, and that payment is not going to change over the life of your loan. However, not everyone needs or will really benefit from this type of mortgage. So it's important that we understand the ins and outs of some of the other options too, like our adjustable rate. So adjustable rate mortgages can sometimes get a bad rap. And yes, they are a little bit harder to understand. But if we understand the benefits of this type of loan and we relate it to our own situation, we may find that this is actually a great option for our situation. So let's take a look at this a little bit more so we can understand this. An adjustable rate mortgage has 2 separate periods. So they have a time period when that loan rate will not change, and then they have the ability for that loan rate to change over a certain period of time, okay? Now, the rate on that mortgage is always going to be based on 2 different things. It's going to be based on an index, and it's going to be based on a margin. So an index is generally something that is brought in from the larger financial markets. For example, the 1-year Treasury bond return rate. So that could be an index, and that may change depending on what happens with those broader financial market conditions. Your margin, however, is a percentage that's added to that index, and that won't change. So although we think that these adjustable rates can change, there are some limits on how they do that, and there are some guidelines. It doesn't just come kind of out of the clear blue. Our rate can't change in ways that we don't understand if we know what our index is and we know what our margin is. These types of loans are generally best suited for shorter term ownership. We have 2 types of adjustable rate mortgages here at the credit union. We have what's called a 5-1 adjustable rate mortgage and a 3-1 adjustable rate mortgage. So remember, we talked about 2 time periods. We talked about a time period where the rate won't change and then a time period where it may. So on our 5-1 adjustable rate mortgage, it's going to stay the same for 5 years. So that for 5 years, you're not going to get a change to your rate. But then after that, every year, it could change depending on what's happening with that index, okay? So I bet you guys can all figure out the 3-1 now, which is it's going to be fixed for 3 years, And then it may change every year after that, depending on whether that index can change. Now, the amount that your rate can change does have a cap. So it's not going to be able to go sky high in 1 year. There are going to be some parameters around how that loan can change. The adjustment caps for both of our adjustable rate loans are 2% each year or 6% over the life of the loan. So you can't have your loan change up or down any more than 2% in 1 year and not more than 6% over the whole life of that loan. Hopefully that indicates a little bit more about what this adjustable rate is, and it is good for folks who are going to be in their home for a shorter period of time. Maybe they're only actually going to be living there for 5 years, and then they're going to essentially have that loan in the time frame where it's not going to change. This also can be good for folks who might get a lower rate to start and have less upfront closing costs with this adjustable rate option. So definitely something that you want to take a look at. So we do offer construction loans if you want to build the home of your dreams from nothing. You want to build it from scratch. We have the ability to do that with our construction loans. We actually have a whole seminar coming up on that on November 19th, or it is a webinar, so I would encourage you to sign up for that. If the construction loan is something that you're interested in, we'll just give you the highlights, which it is an adjustable rate mortgage. Our construction loans only close one time, which means you go from that construction financing into that permanent financing with just one closing period and one set of closing costs. So that can be a really valuable savings. Generally, the time periods to build the home are about 6 months. Now, there are some extra details that need to be discussed for these loans, so I would definitely talk to a mortgage originator if this is something you're interested in, or attend our construction loan seminar or webinar on November 19th. We talked a little bit about home loan programs that help folks purchase a home, and we have one called the Home Loan Payment Relief Program that is available for folks who are at 80% or below of the area median income. This is an adjustable rate, but it's a lower adjustable rate. It is 1% below our national average, and it also has more favorable adjustment caps, meaning that 1% each year, 5% over the lifetime of the loan. And for first-time homebuyers who qualify, there is a 3% down payment option. We've gone over a lot of different loan types, and it will be definitely in your benefit to talk to your mortgage originator to find out exactly which one of these is going to be best for you. But hopefully that does give you the ability to kind of see what might be out there. Okay, guys, so we have talked a lot about what you need to get that home and what the process is going to be looking like. You guys are here at our webinar probably because we've helped you with some part of your financial process up to this point, and we are really grateful for the opportunity to do that. And we do hope that you'll consider us as you think about purchasing this home. So we make the application process as easy for you as we can. We have a lot of guidelines that can help you through that with your mortgage originator and some online processes which make that easier for you to navigate, especially today. If you choose OUCU, you also never have to wonder where your mortgage is. Your payment will come to the credit union for the life of your loan, and that can be really reassuring. If you have an issue with your payment or you have some question about your loan, you can always come back and talk to us. You don't have to deal with a third-party servicer. We have got your back. For those of us who do banking with the credit union, it can be super convenient to make your payments through online banking. And we're going to brag just a little bit here. We are the top mortgage lender in Athens County. We are really grateful for this honor because it means we've helped a lot of individuals reach that goal of homeownership. And we are really proud of what we've been able to do for our community. So I do hope that that gives you some information about the process and also why you might want to work with us on that process. Great, guys. If you're ready to apply, go over to our website and take a look at our online mortgage click application. In fact, if you're not ready to apply, there are also some great tools on there for you to understand even more about this process. We're going to go to this last slide here, which is our wonderful mortgage originators, Shelby and Kristen. There's some information on the screen there if you want to follow up with them directly. I'm going to leave that up here, and then I'm also going to dig back into the questions for these chats. So we have got, we talked about the starting a new position. So we're going to back up to loan qualifications and credit references. Is that related to one person and not per household? Yes, very great question. The 3 credit references with 2-year history are generally required for each person that's going to be on the loan. So hopefully that answers that one. So we have another question about when 2 people buy a home, they are together but not married. Are there any things to look out for? So the ownership of the property is something that you'll want to discuss. Generally, when both people are on their loan, both people will be on the deed. So that is just something that can follow even a non-legally joined married couple through the life of that loan. So that's something that you want to be comfortable entering into that kind of contract with another individual. But in terms of your credit, being married does not give you any other benefits to that credit report. Those credit reports don't get combined. The folks who are on the loan are the credit scores and the income that's being required. So there's not a ton that we need to be concerned about on our process side when individuals are not married but purchasing a home together. And I will ask my mortgage originators and manager to chime in if I have missed anything on that one, but I think that should kind of cover that. Okay, we're going to keep on going down. What if it says lender, but I think it may mean seller. So what if the seller has agreed to pay closing costs? The buyer will get a credit for the closing costs that are outlined in the contract in that case. So that is something that we'll take a look at when that contract gets signed. And if you are going into it knowing that maybe the closing costs are going to be an issue, that's something that you'll discuss with your mortgage originator so that they know that's going to be part of your negotiations. But essentially, yes, if that's written into your contract, that will be included in the final calculations in terms of what needs to be brought to the table on the day that you close. Okay, and then we've got, does a rental contract count towards a credit reference? What about utilities and AEP? So this is going back to that previous question about 3 credit references over a 2-year time period. We do have the ability to use a non-traditional way to qualify individuals. And in that case, yes, a rental contract, as long as we can have verification from the landlord that payments have been made, and there's a special form that we can help you create for that, that will require that person's signature. And then you can request for utilities like AEP to give you information on your payment history with them if you would like to include that as part of your credit qualifications. However, the individual whose name holds that utility is the one who's going to get credit for that payment. So if you're talking about a household where there's 2 individuals, maybe only one is on that AEP bill, that individual is the one who will be able to use that as part of a non-traditional credit profile. Okay, then we've got what would you need to consider for debt to income ratio for a married couple? So generally what will be considered in your credit to debt ratio is if you're purchasing a home, we'll use your new mortgage payment. We do not include utilities, but we do include any payments like a credit card, an auto loan, or a student loan. So hopefully that clarifies that a little bit. Are there any additional requirements for individuals working on visas? We're going to follow up with you by email or reach out to you directly on that just so that we can get the information regarding that particular situation. Okay, great. So we've gotten just a couple more, I think. Can one person on the loan have two forms of credit or loans and the other count as the three? So can we kind of combine the two borrowers to make that three? That's something that you probably want to talk with your mortgage originator on. They're going to be able to look at an individual situation a little bit better than I can kind of in a broad bird's eye view right now. But we certainly would love to talk to you, and we don't want these kind of general qualifications to keep anyone from having that initial conversation where we can really do the discovery to find out what's going to work for you. So yes, please go ahead and contact us so that we can kind of talk about that a little bit more. Okay. How do you calculate what your closing costs may be? There is a super handy tool on that Mortgage Click service that I talked about. It's called the Loan Consultant, and it is going to take your loan amount and it's going to calculate some estimates for those closing costs. And it can be really handy when you're thinking about what those payments are going to need to be. It does ask for you to have some idea what your credit score is. So if you have some information on that, it can be even more helpful. Okay, what about a car loan that has been paid off already? Will that count? In general, it would be part of how we would consider how long it's been paid off. So if it's been paid off for a number of months, maybe closer to a year, we may not be able to consider that as an active line of credit. However, if it's October now, you paid it off in September, that might still be more in the range. So something to talk about with your mortgage originator so that they can give you a little bit better guidance in terms of exactly what we're looking at in that particular situation. Great, guys. I have made it to the end of my questions. I really appreciate your time and attention here today. We will go back through this chat and we will reach out individually if there was a question that we missed. Please also feel free to stay on and ask any questions that you need to. It is 1:05, so I'm sure many of us are going to have to get back to the rest of our afternoon. There is a survey that will pop up as you close out of this meeting today. If you can let us know how we've done, we would really appreciate it. And then I will send out those additional supplemental resources and a copy of this recording probably by Friday, the end of the week here, okay? Thank you so much for joining us.